Ray is 53 years old. He lives in Colorado with his wife. They've been saving for retirement for over 20 years, doing everything they were told to do. Contribute to the 401k, pick a mix of funds, stay the course. Ray has 11 different funds in his brokerage account right now. 11. He pays fees on every single one. And last year, after all that effort, his blended return came in at 9%. That's not terrible. But then Ray saw something that made him stop cold. A chart showing a simple two-fund combo, just VOO and QQQ, that returned 18.97% per year for an entire decade. Not a hedge fund, not some complicated options strategy. 2 ETFs you can buy on any brokerage app in about 30 seconds. Ray stared at that number, and his first thought was, is that even real? It is real, and by the end of this video, you'll know exactly what those two funds are. You'll see the verified dollar amounts, you'll understand what's actually inside them, and you'll learn the one thing most people get dangerously wrong about this combo, the thing that could cost you serious money if you don't see it first. Quick note, I'm not a financial advisor or government employee. Everything here is for educational purposes only. For your specific situation, always check with a qualified professional. Now, before Ray made any moves, he needed to look under the hood of these two funds, and what he found completely changed how he thought about them. The foundation, what VOO actually delivers. The first fund in this combo is VOO. That stands for the Vanguard S&P 500 ETF. When you buy one share of VOO, you instantly own a small piece of 507 of the largest companies in America: Apple, Microsoft, Nvidia, Amazon, Alphabet, Broadcom, all of them in one single purchase. And here's what it costs you. $3 a year for every $10,000 invested. That's an expense ratio of just 0.03%. You almost can't feel it. So what has VOO actually done for investors? Over the past 10 years, VOO has returned about 15.5% per year. Now, I want to be specific here. A lot of videos and articles out there still say 14%. That figure is slightly outdated. The verified 10-year annualized return right now is closer to 15.5%. What does that mean in real money? If you put $100,000 into VOO 10 years ago and never added another dime, just let it sit, that money would be worth roughly $425,000 today. Let that land for a second. $100,000 became $425,000. One fund, $3 a year in fees. Now, here's something else smart investors pay attention to. About 96% of the dividends VOO pays out are qualified dividends. That means they get taxed at the lower long-term capital gains rate, 0, 15, or 20%, instead of your ordinary income rate, which could be as high as 37%. If you're investing in a taxable brokerage account, that difference in taxes adds up to real money over time. The top holdings in VOO right now are Nvidia at about 7.9%, Apple at 7%, and Microsoft at 5%. Technology makes up about 33% of the fund. The rest is spread across financials, healthcare, industrials, consumer stocks, energy, and more. 10 different sectors in total. VOO is broad, it's cheap, it's tax efficient, and it has a decade of verified results behind it. But it's only half of this combo. So if VOO turned $100,000 into $425,000 in a decade, what if I told you the second fund nearly doubled that result, and it only holds about 100 stocks? The growth engine, why QQQ changes the math. The second fund is QQQ. That's the Invesco QQQ Trust. QQQ tracks the Nasdaq 100. That gives you 101 of the largest non-financial companies listed on the Nasdaq exchange. No banks, no insurance companies. This fund is built for growth. The expense ratio is 0.18%. That's 6 times more than VOO. Still cheap by any standard, but here's why millions of investors are happy to pay it. Over the past 10 years, QQQ has returned 18.97% per year. That's the number right in this video's title, and it's verified, sourced directly from Invesco and Bloomberg as of March 31st, 2026. But here's what's even more striking. Live trackers right now show the trailing 10-year return has actually climbed to about 21.8%. The number in the title is already conservative. Let me put that into dollars. $100,000 in QQQ 10 years ago, worth roughly $700,000 today. That is not a typo. $700,000 from a single fund. Now, there's a reason QQQ grows like that. Technology makes up about 59% of the fund. The top 10 holdings represent 47% of QQQ all by themselves. Nvidia, Apple, Microsoft, Amazon, Broadcom. These companies are doing the heavy lifting. The dividend yield is only 0.4%. That sounds like a downside, but it actually makes QQQ one of the most tax-efficient growth funds you can own. Tiny distributions mean a tiny tax bill each year. But I have to be honest about something, and this is the part most people skip over. In 2022, QQQ dropped 32.58%. If you had $100,000 invested, you watched it fall to about $67,000. And during the dot-com crash back in 2000, QQQ lost 83%. It took 13 years to recover on price alone. That kind of concentration gives you incredible upside, but it also gives you incredible downside risk. Now, here's where most people make a big mistake. They think, okay, so I'll just own both VOO and QQQ. That way, I'm diversified. Let me show you why that's a myth. Here's the myth. Owning VOO and QQQ together gives you about 600 different stocks. Sounds like solid diversification. Here's the truth. 52% of these two funds overlap by weight. Nearly 95% of everything inside QQQ is already inside VOO. Nvidia, Apple, Microsoft, Amazon, Broadcom, they're all in both funds. You're not adding 100 new companies, you're doubling down on the ones you already own. So if half the holdings overlap, what are you actually getting when you combine them? Let me show you the real math, and this is the part that changes everything. The combo unmasked, real dollar math, and the overlap truth. When you combine VOO and QQQ in a 50-50 split, you get a blended return of about 17% per year over the past decade. Let me show you what that number actually means for someone in their 40s or 50s. Say you had $200,000 to invest 10 years ago. You put half in VOO and half in QQQ. That $200,000 would be worth roughly $800,000 to $960,000 today, approaching $1 million from two funds. Or maybe you're building from scratch, $500 a month into a 50-50 split. After 10 years at historical rates, you'd have roughly $130,000 to $145,000. And you only put in $60,000 out of your own pocket. The rest was pure growth. Those numbers really happened. The data is verified. But now you need to see what's underneath those numbers. When you combine VOO and QQQ, your combined technology exposure jumps to about 43%. Almost half your money rides on a single sector. Your blended dividend yield drops to about 0.8%. On a $500,000 portfolio, that's roughly $4,000 per year, about $333 a month. That is not a retirement paycheck. And you have zero bonds, zero international exposure, zero small-cap stocks. This combo is a powerful growth engine. I mean that. The returns speak for themselves. But it is not a complete retirement plan by itself. It's one part of a plan. Let me bring Ray back in. He's 53 years old. He saw those returns and he almost went all in, put everything into VOO and QQQ. Then he looked at what happened in 2022. QQQ lost a third of its value in a single year. A 50-50 blend would have dropped roughly 25%. At 53, maybe 5 to 7 years from drawing income, that kind of drop doesn't just hurt, it sets you back years. And that's when Ray stopped asking the wrong question. He stopped asking, should I buy this combo? He started asking the right one, how should I use it? Before I show you exactly how Ray structured this, drop a comment right now. Are you already holding VOO, QQQ, or both? Or are you still deciding? I read every single comment. What smart investors actually do with this combo. Here's the thing. The smart move isn't to avoid VOO and QQQ. The returns are real, the track record is verified, the costs are low. The smart move is to size the combo correctly inside a larger plan. Instead of a 50-50 split, consider going 70-30 or 80-20, heavier on VOO, lighter on QQQ. You still get the growth tilt, but you cut down on that overlap concentration. Now, here's a quick money-saving tip most people miss. If you're buying and holding for the long term, use QQQM instead of QQQ. Same exact index, same exact 101 holdings, but the expense ratio is 0.15% instead of 0.18%. Over 10 or 20 years, that small difference compounds into real savings. Same thinking applies on the S&P 500 side. SPYM charges only 0.02% per year. IVV is 0.03%. There's even an ETF called BKLC that has a 0% expense ratio, literally free to hold, though it's a smaller fund with a shorter track record, so do your homework before choosing it. Now, here's something that separates informed investors from everyone else. Where you hold these funds matters as much as which ones you pick. QQQ and QQQM are growth machines. They barely pay dividends. That makes them perfect for a Roth IRA or another tax-advantaged account. Let them grow and compound tax-free for as long as you possibly can. And then pair this combo with what it's missing. That's the real key. Add international exposure. Something like VXUS gives you thousands of companies outside of the United States. Add bond ballast with a fund like BND to cushion the downturns. And if you want true diversification beyond big tech, consider a small cap value fund like VBR. This is exactly what Ray did. He went from 11 scattered funds, some overlapping, some expensive, none of them working together, down to 4 with a clear purpose. 50% in VOO as his core, 20% in QQQM as his growth engine, 20% in VXUS for international diversification, and 10% in BND for stability. His fees dropped dramatically. His expected growth stayed strong. His portfolio finally made sense as one plan instead of 11 random pieces. And here's what mattered most to Ray. He could finally understand what he owned. He could explain it to his wife in 2 minutes, and he could sleep at night knowing that one bad quarter wouldn't wreck his retirement timeline. Ray didn't need a different strategy. He needed to understand the one he was already looking at, and once he did, the right move became obvious. 2 funds can build serious wealth, but only when you understand what's inside them. Now, keep in mind, the past 10 years do not guarantee the next 10. Valuations right now are stretched. The S&P 500 forward PE ratio sits around 22.7. The Nasdaq 100 is even higher at about 25.5. And with the Fed holding rates at 3.5 to 3.75%, future returns may look different than the last decade. Smart investors plan for that. They don't just chase past numbers. They build portfolios that hold up no matter what the next decade brings.
If someone you care about is sitting on a pile of overlapping funds, or maybe they keep hearing about VOO and QQQ but don't know where to start, share this video with them right now. It could save them real money and a lot of confusion. Now, here's my question for you. If you could only hold 2 ETFs for the next 10 years, which 2 would you pick? Drop your answer in the comments. I want to see your picks. If you're building wealth from your investments and want to stay ahead of moves like this, subscribe to this channel. I break down everything that helps your money grow smarter, in plain English with real numbers. And next up, I'm breaking down the 3 biggest tax mistakes investors over 50 make with their ETFs. If you're holding funds in the wrong account types, you could be leaving thousands on the table every year. You don't want to miss that one.